Hi to all. In this video, we will cover the box spread. So we already have a couple of values here that will help us to complete what the box spread is. But in essence, in a box spread, what we do is we form, it's a combination of a bull spread, and we form the bull spread with call options because we want to avoid that early exercise risk. And then a bear spread, and as usual, we form the bear spread with put options because we want to avoid the early exercise risk. And then we combine these two um, strategies. Now, the interesting feature of a box spread is that, and we will see this in the chart, a box spread is a riskless strategy. Now, a riskless strategy, whenever we talk about zero risk in finance, we're not talking about, well, you always have the possibility of making money. When we talk about risk, zero risk means the payoff you are expecting is a constant. So if you have a rainy day, a sunny day, snow, uh, it's a hot day, regardless of political event, some situation, the outcome of that situation, regardless, good state of a world, bad state of a world, you will always end with the same payoff. And that payoff is therefore a constant. So if you calculate the standard deviation or the risk of that total risk of that payoff for across all the different possible scenarios, then this standard deviation would be zero. It's a constant, right? It will not change. So you can go on vacation, you can do anything you want, and you have certainty that the payoff will be this X amount. Let's take a look, and we will understand this very clearly as soon as we see this chart coming up. Once we have completed the this spreadsheet. So bull spread with call options, we don't need to do much. We This is exactly the same we have done when we have formed a bull spread. And if you are not clear yet, I would suggest you watch the video on the bull spread with call options first. So step one, we get the intrinsic value and the intrinsic value of the two call options. In a bull spread, we're buying the low strike call, we're selling the high strike call. Okay, but before we do that, let's calculate the intrinsic values for both. The intrinsic value of C1, which is the call option with the low strike price, is stock price minus strike. We lock this strike sell, comma 0. The intrinsic value of this call option 2 is stock price minus strike 2. We lock this or 0. And then we scroll these two down. And once again, we see that there is a difference, like a constant difference, right, between these two, which is of course coming from the different strikes. Then the profits, okay? When we think about the profits, this is like a story. So in a bull spread, we're buying the low strike call, we're selling the high strike call. So we're buying the low strike call at the low strike call premium, at the premium what it costs you to buy that call option, which is $2 in this case. I'm gonna lock this, and because you have bought it, and that's why it's negative here, right? You're buying it, so you paid the $2. Then you are entitled, or you get this intrinsic value here. Next, we also sell the high strike X2 call option, and the premium we can see here that is 1. We lock this, and because we have sold it, or in other words, we have written that option, now we are liable. Now we are supposed to, we're giving basically a guarantee of selling to this other investor at a given price, regardless of whether the stock goes up or down, right? If the stock goes up, the call option gets in the money, we have to sell at this strike price. And then because of that, the intrinsic value, we can think about it as, well, it's to some extent we can think that we are losing the intrinsic value. Now we scroll this down, Keep in mind to lock the cells that I locked here. And then we can see this. As a matter of fact, I'm going to do this line very quickly, right? That's how a bull spread looks like when stock prices are low to the left, right? Then you lose money. When the stock prices are high, you're making money, right? But we are not. This is not about the bull spread. This is about the box spread. So let's multiply this by 100. So we have the profits and losses of the entire contract here. Then we form a bear spread. And one interesting feature when we're forming the box spread is we only use two strikes. So the two strikes, X1, X2, are the same for call options and for put options, right? So what we will do here with the bear spread with put options is we will buy the put option with the high strike and we will sell the put option with the low strike. And the high strike is X2, which is the same high strike we use in the bull spread. And the low strike is X1, which is the same low strike we used in the bull spread. So let's get first the intrinsic values of these two put options. Intrinsic value of P2 is basically max of strike 2, and we log this minus the strike price, comma 0. Then the intrinsic value of P1 is max of X1, the strike 1, minus the stock price or 0. And then we just scroll these two down. And there we go. Now we have the profits. So let's keep in mind the story. In a bear spread, we're buying high strike, we're selling low strike. So we are buying negative the high strike put. So the high strike put is P2 because P2 is the put option connected linked to strike X2. So we'll invest, we pay $1 for that. Let's lock it. And because we did that, then we are positive entitled to the intrinsic value of P2, I'm sorry, of P2 here. Then we're going to sell positive. We're going to sell the low strike put, which is P1, which is the put option with strike X1, which is a low strike. And we lock this. And because we sold or we wrote this put option, then we are liable, or in other words, we lose this put option, the intrinsic value of the put option 1. Once we do this, I'm just scrolling down and you see that there's a higher value depending on the premiums. If you're using real data, then from Yahoo Finance or any other source, this is not likely positive, it will be likely negative, right? But then this looks like a bear spread if we plot it in the sense that you're making money when the stock prices are low to the left, and you're not making money, or you're making little money here. But if you use real data, then this would come down to a negative ground, so you would end up losing money when the stock prices are low, but of course a limited loss. We multiply this by 100, then we scroll this down, so we have the profits, but by contract size. Now box spread, we just add the two. And you will notice something interesting. When we do this, then our profit is always 1000. I mean, one interesting thing is here, we have the maximum loss, maximum gain, but we have this value here in between, right? And even like we have these three different values, we can see that we might have even a little bit more values in between the minus 1900 if we look at this, if we increase the price dollar by dollar, right? But for at every point, if you have minus 100, then you have 1100, so you end up with 1000 in profits here. If you have 400 here, then you have 600 here, so you end up with 1000. And if you have 900 here, then you have 100 here. So long story short, you always end up with 1000. So when we plot this, right, in let me add the value, select data, the prices of the stocks that we are talking about, that we are considering here. So long story short, we are considering these possible stock prices by the time we close our box spread. The stock could go down to zero, or it could go up to 100. You could continue and just check what happens if the price is a million, regardless of if it's zero or a million. If you are investing in a box spread, you will always get $1,000, right? So that's why it's riskless. It is riskless because it doesn't have a variation. There is not variation, therefore there's no volatility, therefore there's no standard deviation, therefore there's zero risk. So the zero risk here means it doesn't mean that you always end up with profits necessarily. You can have a box spread that may not give you profit, right? But you will end up with this payoff that is constant, and so you can predict with perfect accuracy what the payoff will be. And if the stock goes down, it plummets, you get that payoff, and if the stock goes up, you still get that payoff. Now, one last feature of the box spread is that the return you should get from investing in a box spread should be similar to a riskless asset, which we can think about treasury rate, in which an investor has no risk. The profits from investing in a box spread should be similar to that, because if the box spread is giving you a higher return than that, then you or a lower return than that, you may have a profit, an arbitrage opportunity right there that you could exploit. And by exploiting it, if many investors step in and start exploiting it, then they would push the prices in such a way that that arbitrage opportunity would be closed, and then the box spread would give a similar return as a treasury rate or riskless assets do. Okay, so I hope this was helpful. With having this said, I think we have concluded the box spread. And if you have any questions or doubts, let me know. Let's keep in touch. Thank you for your attention.